That's the U.S. national debt as of January 7th, 2026, and it's not a headline. It's the number sitting behind your mortgage rate, your car payment, and your safe savings account. You've probably seen the scary claim floating around. Japan is about to dump U.S. Treasuries and crash America. So today we're doing the exact opposite of panic. This video is titled, If Japan Sells U.S. Treasuries, What Actually Happens? Numbers, not headlines, and I'm going to debunk the fantasy version first. Because the debt isn't disappearing, your purchasing power is. And here's the contrarian truth. If Japan sells, the real hit won't be a Hollywood-style collapse. It'll be quieter, legal, and it will land directly on your life in ways you can measure. By the end, you'll know the three numbers that actually matter, the three levers Washington policymakers can pull, and the one thing almost nobody says out loud. The safe path is the one that slowly punishes you. And watch what happens when we stop talking in vibes. Start talking in math. Meet Jordan. Jordan's mid-30s, doing everything right, high-yield savings account, 401k. No meme coins, no gambling, no fancy lifestyle. Jordan lives in an expensive U.S. metro, where rent renewals feel like ambushes. Every year, the paycheck goes up a little, and somehow the feeling of being behind goes up a lot. Jordan opens the bank app, sees the balance, and still feels poor, because the finish line keeps moving. Then Jordan hears the rumor. Japan might sell treasuries, and immediately the fear snaps in. If the biggest foreign holder starts dumping, what happens to my mortgage rate, my job, my retirement? Jordan's not asking an academic question. Jordan's asking the only question that matters. How does this end? And here's the scary part. If you understand what happens when Japan sells, you'll understand what happens when any buyer flinches in, why Washington policymakers always choose the option that looks painless in the short term and expensive for you over time. Let's get scale and speed out of the way, because your brain needs the reality before it can feel the danger. As of January 7th, 2026, the U.S. gross national debt is about $38.43 trillion. Over the past year, it has risen at roughly $6.17 billion per day. That's about $257 million per hour, about $4.29 million per minute, about $71,000 per second. While you're watching this sentence, the number just climbed again. And the most important part isn't the headline total. It's the treadmill underneath it. About 1/3 of publicly held marketable U.S. debt is maturing within 12 months. That means Washington policymakers aren't just carrying debt, they're constantly refinancing, trolling it over like a household, paying off one credit card with another card, every month, forever. So when anyone says Japan sells, what they're really saying is, one big source of demand might step back, right when the U.S. needs demand the most. And the moment demand gets shaky, the price of borrowing doesn't politely drift. It snaps. Now here's the hook. Japan doesn't need to sell everything to matter. They just need to sell enough to change expectations. The monster isn't the $38.43 trillion. The monster is the interest. In fiscal year 2025, interest costs climbed to around the $1 trillion range. Interest on the debt hit about $1.2 trillion. That's not infrastructure. That's not healthcare. That's not education. That's payment for yesterday. Interest is a budget predator. It eats first. And it gets worse because the refinancing treadmill forces Washington policymakers to constantly issue more debt at whatever today's rates are. Now layer in one more number that most people miss. As of December 2025, the average interest rate on total marketable debt was about 3.36%. That sounds tame until you realize how fast trillions roll over. If rates move up just 0.5% and stay there while trillions refinance. You're not talking about a little higher. You're talking about hundreds of billions more in annual interest over time. That is the trap. So when people scream Japan sells treasuries, the real fear isn't Japan. The real fear is what higher rates do to a government that must refinance constantly, and what that government will do to avoid feeling that pain. Yes. And yes, this is where your life comes back into the frame. No. I need you to understand one phrase, because it's the center of the whole story. Quiet default doesn't mean Washington policymakers miss a payment. It means they pay you back in full, with dollars that buy less. Here's the simplest example. Imagine you lend your friend $100 for 1 year. They promise to pay you back $100. They do. But during that year, prices rise 10%, so you got your $100 back. And it buys what $90 used to buy. Legally, they paid you. In reality, you lost. That is quiet default. Now, connect it to Treasuries. Treasuries are safe in nominal terms. They pay. They settle. They don't bounce. But if inflation outpaces what you earn, then holding Treasuries or holding cash that behaves like Treasuries is a slow leak in your purchasing power. And here's the twist that matters for today's video. A shock like Japan sells Dosen-T just change yields. It pressures Washington policymakers into choosing between two kinds of pain. One pain is loud, higher rates, visible spending cuts, visible tax hikes, visible recession risk. The other pain is quiet, dilution, financial repression, paying the debt, but shrinking what the dollars mean. You already know which pain politicians prefer. Mechanism number 1, negative real returns, the invisible tax. Let's anchor this with dates because vibes are useless. In the U.S., CPI inflation was about 7.0% for the 12 months ending December 2021. It was about 6.5% for the 12 months ending December 2022. It cooled to about 3.4% for the 12 months ending December 2023, and by the end of 2024, it was about 2.9% year over year. By late 2025, the reported number was around 2.7%. Now here's why that matters for Treasuries and for Japan. If you earn 3% and inflation is 4%, you're losing 1% in real terms. That sounds small until you compound it. You can do everything right for 10 years and still end up with less real life than you started with. Now think like Japan. Japan held roughly $1.20 trillion in U.S. Treasuries as of November 2025. That's not a trading position. That's a national reserve asset. When inflation is higher than the real return, the safest asset on earth becomes a guaranteed, politically acceptable loss. So Japan has a rational motive to diversify, rebalance, or sell at the margin, especially if Japan needs dollars for currency defense or if domestic pressures force changes. But here's the debunk. Japan sells is not automatically America collapses. It's America's cost of money shifts, and then Washington policymakers choose who eats the cost. And you already know who rarely gets protected first. Mechanism number 2, captive buyers. This is the part nobody wants to explain because it sounds like plumbing, but it decides everything. The U.S. Treasury market is enormous. By the end of 2025, there was about $30.3 trillion in treasuries outstanding. And in 2025, the market traded around $1 trillion a day on average. That means this market can absorb huge flows. So if Japan sold, say, $1.2 trillion evenly over a year, that's roughly $5 billion per trading day. In 1 trillion Australian dollars per day market, that's not a nuke. But markets don't move on averages. They move on stress. They move on. Everyone front runs the big seller. And the bigger truth is this. Treasuries have structural buyers who dainty buy because they love America. They buy because they have to. Banks need safe collateral. Pensions need duration. Money market funds need bills. Regulations and mandates create forced demand. Even when the yield is unattractive, the system still needs treasuries as the base layer. So the question isn't, can the market absorb sales? The question is, what yield does the market demand to absorb them without a buyer panic? That yield sets your mortgage rates. It sets your corporate borrowing costs. It sets your job market, and Jordan feels it before any economist does. Mechanism number 3, the central bank backstopped in modern financial repression. This is where conspiracy people get loud, so let's keep it clean. The Federal Reserve is not a comic book villain. But the Fed is the mechanism that keeps the Treasury market functioning when stress hits. There is a standing facility created as a temporary crisis tool in 2020 and made permanent in July 2021 called the FIMA repo facility. Here's what it does, in plain English. It lets foreign official holders temporarily swap treasuries for dollars instead of dumping treasuries into the open market. That means even if Japan needs dollars, there is a route that doesn't require sell everything and crash yields. Now let's talk about the bigger lever. Yield control. The U.S. has done versions of this before. During World War II, the Fed pegged Treasury bill yields around 0.375% and capped long-term government bond yields around 2.5% to help the government finance war spending.
Theory, precedent. And if debt costs spiral, the temptation returns. Don't let rates rise to high, manage the yield curve, keep borrowing costs contained. But here's the catch.
If yields are held down while inflation runs above them, that is financial repression. It's a quiet default machine. So when you ask, what happens if Japan sells? The real answer is, Washington policymakers will do what it takes to prevent a disorderly spike in yields, because a disorderly spike breaks everything. And if the choice is between protecting the system and protecting your purchasing power, you already know which one gets priority. Now here's the scary part. You can stabilize markets and still quietly drain the middle class. Who pays you? And Jordan. And anyone who lives off wages and safe savings. Dilution hits different people at different times. When money gets created or liquidity gets protected, it tends to touch asset markets first. Stocks can float. Real estate can stay propped. Credit can keep flowing. But wages lag. Always. So Jordan's rent renews higher today.
Nice.
Jordan's groceries cost more today. Jordan's insurance premiums jump today. And Jordan's safe savings? It feels like a joke, because the system can keep functioning while Jordan's life gets tighter. That's the emotional betrayal beat. You were told, save cash, buy safe funds, be responsible. And then the system quietly changes the definition of safe. Now link this back to Japan. If a big buyer steps back, yields want to rise. Higher yields make government interest costs explode. So the incentive becomes, keep yields from rising too far, too fast. Which often means, suppress yields, tolerate inflation, let time do the dirty work. That's not a crash, that's a transfer. And it's why the headline fear is misplaced. The danger isn't a single day where Japan dumps. The danger is a decade where your dollars buy less. While the debt stays paid, history rewind. Because if you think this is new, you're blind to the playbook. During World War II, the U.S. needed to finance enormous spending, so policy pegged rates. Short-term bills around 0.375%. Long-term bonds capped around 2.5%. They kept borrowing costs low. But it also set up a reality. When inflation rises while yields are held down, debt shrinks in real terms. The government's burden softens. The saver's purchasing power gets sacrificed. Again, not conspiracy, precedent. And after the war, when inflation pressures grew, the tension between financing the government and controlling inflation became so intense, it contributed to the famous 1951 Treasury Fed Accord, basically a fight over who controls rates. So when people today say they would never do that, history says they already did. Now bring it back to Japan selling treasuries. If Japan selling pushes yields up, the pressure to do something grows. And the something that avoids immediate pain is almost always some version of don't let yields run away. Keep the machine running, let inflation and time do the adjustment, which means your safe savings becomes the release valve. Now the global constraint, the confidence line, because there is one thing Washington policymakers cannot print: trust. Foreign holders matter because they are part of the marginal demand for treasuries. As of late 2025, total foreign holdings of treasuries were around $9.36 trillion. Japan alone was about $1.20 trillion. And yes, if Japan sells aggressively, yields can rise. But the bigger threat is not Japan's sale. It's the story the sale tells. It tells the world a major reserve manager is changing behavior. That's why markets react to signals. Now zoom out. The US dollar's share of global FX reserves has been drifting downward over time. In the third quarter of 2025, the reported dollar share was about 56.9%. Still dominant, still the biggest, but not invincible. So here's the high-stakes line. If foreign confidence erodes slowly, demand becomes more price-sensitive, meaning the U.S. has to offer better yields to attract buyers. Better yields raise interest costs. Higher interest costs intensify the incentive for quiet default. This is the spiral, not overnight. Over years. And Jordan doesn't get a press conference when that spiral taxes their life. Jordan just feels it as, why is everything harder? So what do you do with this without panic, without cosplay, without pretending you can time macro? Here's your defense framework. First, stop treating nominal safety as real safety. If your entire plan is cash and safe bonds, you are betting your future on Washington policymakers choosing your purchasing power over political stability. That is not a bet I would make. Second, build flexibility into your life. A 1-month emergency fund is a joke in a world where rates can spike. Layoffs can cluster and safe assets can quietly lose value. Aim for resilience. Lower fixed expenses, longer runway, less forced selling. Third, understand your exposure. If a 50 basis point move in mortgage rates changes your life, you are living on a knife edge. On a $400,000 mortgage, that 0.5% can mean roughly an extra $130 a month. That's not theory. That's groceries. That's childcare. That's stress. Diversify your sources of survival. Not a hot stock tip. Not a magic asset. Real diversification. Income skills. Career optionality. Geographic flexibility. And long-term assets that don't rely on the government keeping your dollar strong. Not financial advice, just reality. Because the point of this video isn't by X. The point is, if Japan sells, the system will protect itself. Your job is to make sure your household isn't the shock absorber. Back to Jordan. Jordan watches the headlines, feels the fear, and thinks the danger is some dramatic treasury dump that ends everything. But the real danger is quieter. The U.S. gross debt is $38.43 trillion, and it keeps rising by billions per day. Interest costs are already near the trillion-dollar neighborhood. Huge chunk of debt keeps maturing and refinancing, forcing Washington policymakers to choose between painful honesty and quiet dilution. So if Japan sells U.S. Treasuries, what actually happens? Not an instant apocalypse, a shift in yields, a stress test in refinancing, and an even stronger incentive for Washington policymakers to keep the machine running by any means, because the debt isn't disappearing your purchasing power is. That's the ending nobody headlines. Now I want you to do something for me. Comment your city and the current time where you are, and tell me one thing that got more expensive since 2021. Make the comments the real inflation report. And in the next video, I am going to show you the one chart that explains why safe money has started to feel like a trap hand, how to spot the next pressure point before it hits your life.